Thanks. And I think there'll be some pages collecting cards also in the aisles. Well, Bill, there's an old saying that it's a recession when your neighbor loses his job, and it's a depression when you lose yours. And speaking as a Bear Stearns alumnus, you probably know where I fall out on that debate. But I'm curious, you can't pick up a newspaper or a magazine these days and people saying, worst data points since the 1930s. Are we in a depression? Are we heading towards a depression? And perhaps, more importantly, how would you contrast what's going on right now versus the 1930s?
Yeah, you do hear that reference to the worst since, and many and in terms of this credit issue that we're dealing with is certainly something that we haven't dealt with to this magnitude since the 1930s. So it's very easy to start linking up and thinking about that period. But I think there's a lot of reasons why we want to be understanding that we're going to avoid having those kinds of deep downturns. So I had several data showing, or that one table I had up there showing how we're going to likely be compared to recession since the 1960s. And we're going to be on the extreme end. So the worst that we have seen over the last 40, 50 years has been about a 3%, 3.1% drop in GDP. During the Depression, GDP fell by 26%. Unemployment rates, the worst that we have seen since the 1960s, was a 10.8% rate reached in the early 1980s. In the Depression, we reached 25%. So, we're clearly in a whole different league in terms of even what we're thinking about for this round. And there are reasons to understand that why we're going to avoid the depression-like effect. There were a lot of mistakes made during the Depression. I mean, it took a recession, and really, many policy actions messed things up. And the policy actions were all of the bank failures that began to occur caused the money supply to really collapse. And we certainly have the FDIC in operation, backstopping a lot of these deposits, and the number of bank failures have been more limited at this point. In addition to that, the Fed was not aggressive with monetary policy, and in fact, it has been far more aggressive this time around. Fiscal stimulus response was that back then it was believed that you should have a balanced budget. So as tax revenues began to fall because of the income losses that were occurring, the federal government went ahead and started to reduce its spending. Of course, we're doing the exact opposite today. People worry about is there too much policy and what's happening to our fiscal deficit and federal debt level. But this is what you do during economic weakness. Finally, we put in this Protect America policy back in the 1930s, the Smoot-Hawley Act, which raised tariffs up to 50%. And we saw this very significant drop in global trade. Very disastrous for world trade and for the U.S. So we're not seeing those kinds of policy actions this round. In fact, we're seeing the opposite. We're seeing a very positive response.
Gotcha. Yeah, there's a new phrase that's been gaining some popularity in the financial world. It's called the new normal. Do you think that consumer spending and industrial production has been effectively reset? For instance, the automotive SAAR today is about 10 million. A few years ago, people thought the normalized SAAR was 16, 17. Some of those people now say, no, new normal is 13, 14 million. Is that accurate, or do you think that's just a reflection of the times that we're in right now?
No, I think there is some legitimacy to this in terms of the consumer psychology with regard to a lot of different purchases. As I mentioned, we have more vehicles than we have licensed drivers. So is there an economic justification to be thinking that consumers, if they have to cut back, might be cutting back on some of these bigger ticket items? I think there is some legitimacy to that. In addition, the frenzy with regard to the housing industry, where people were buying these as investments, I think with the understanding that, in fact, that the concept that house prices can only go higher and not lower, there has to be some rethinking where people are going to be viewing homes and comparing that to renting a place as more of an economic decision of which is a better deal, and paying less attention to it being an asset that will be gaining in terms of its capital appreciation. But the problem, and it wouldn't be the worst thing to see better savings performance by consumers. I think part of that was the fact that we were seeing these home price appreciations. A lot of people were just replacing outright typical traditional savings with this capital appreciation on their house. It wouldn't be the worst thing to see them go back to the traditional way of thinking about savings, which is saving out of income, taking advantage of 401ks and some of those programs that are in place and otherwise. But when you do that, that is one of the conundrums that we deal with. This is what's referred to as the paradox of thrift. That while we understand, and we saw that when this government stimulus checks went out last year, a lot of people paid off credit card debt, they put it aside, and we think of that as a good thing, but at the same time, by them not spending, means that the downturn gets magnified. So, and ultimately, savings is going to lead to better investment, higher investment, and that will ultimately lead to higher levels of GDP as well as rising standards of income. But it's that transition period, that paradox of thrift, that causes the economy to struggle.
That's helpful. This question has come up a few times in the cards. Why won't the economic stimulus program produce massive inflation a few years from now?
Well, there's always a risk of inflation, and that's what the Fed certainly focuses on. Let me just address one I often commonly hear, and that is the very significant increase in the balance sheet of the Fed, and this massive of increase of high-powered money that the Fed has undertaken. Well, ultimately, the vast majority of money is actually created through the lending process, through banks making loans. And as we all know, that's part of the credit crisis, is that banks and other financial institutions are not making the kind of loans that they have historically made. So you need to be looking at it from that standpoint. So as the financial conditions begin to ease and more lending takes place, the Fed will have to be nimble enough to be able to withdraw all of this liquidity response to avoid having an inflationary stimulus. With regard to the fiscal side, they're clearly going to be borrowing a lot more, and that increased demand in the credit markets will probably wind up putting some pressure, that's what the economic theory would suggest, on interest rates. And more importantly, it'll depend upon foreigners and their willingness to continue to fund U.S. purchases of these treasury markets, which has been going on over the last several years. But it's going to be an interesting thing what happens, especially when China, who has had all this excess amount of liquidity, is starting to utilize it domestically to help with their own stimulus program.
There's another set of questions that's very common in the card, so it's clearly very top of mind. I'm going to read two of them because they kind of go at it slightly differently. Since there are no typical recessions, what should we look for in terms of the TARP economic stimulus package and monetary stimuli actually working? And then similar on that line of thinking, what changes will occur in the next few months that will be the drivers of growth in fourth quarter 09 and into 2010?
Well, I think we're going to be having to look at getting ourselves back into a balance. There's been the interesting discussion about whether or not the housing industry can be decoupled from a lot of these other issues. And my personal belief is that you cannot decouple the downturn in housing, that the housing market stabilizing is going to become very important, because it is this falling in the price of homes that has caused a very great confusion about what are the value of these assets, especially in the financial institutions who hold a lot of the portfolio of these mortgages. And once we get stability in that market on the price side, we'll be able to see, or at least it doesn't even have to be quite stability, but at least the slowing in terms of the rate of decline, where it's getting awfully close to zero. We'll be able to better properly come up with a valuation of these assets. So I think that's certainly something that I'll be looking at. Another thing is going to be trying to see what's happening on the employment front. My personal belief is that the employment declines that we have witnessed up to this point have been enormous. But I also think that they have been more aggressive than what the decline in GDP would suggest. So I think that's a little bit ahead of the curve. So I'm going to be watching to see whether or not the employment numbers begin to moderate